Okay, so welcome to Chapter 2. In Chapter 1 we learned assets equals liability plus owner's equity. There were a number of accounts that we used in the accounting equation. What we're going to do now is we're going to show you another method to analyze the transactions. In this formula we had a number of different accounts, like cash, accounts receivable, equipment, liabilities like accounts payable, and we had a number of owner's equity account, the first one being a capital account. There was a bit of a problem with the transaction analysis sheet, wasn't there? What was the biggest pain using that transaction analysis sheet? The totals. Every time you did a transaction, you had to record all those totals. So that was a little bit inefficient. The other thing that was difficult is to know what's in every account after every transaction. So I'm going to teach you another system here that will lay the theory for double entry accounting. I'm going to teach you a T account. Looks like a T. On this T account, I want you to think about a couple of things. It's got a left side and it's got a right side. In accounting, we're going to give you new names for this. The left side we're going to call debit. The right side we're going to call credit. Debit's left, credit right. This is very different from the traditional meaning of these terms. If I was to credit your bank account today, would you be happy? You say, yeah. But in accounting terms, it means something different. You simply have to remember that it means left and right of this account. Each one of these accounts that we had in our balance sheet that we looked at, we're going to create a T account for. I'm going to use these T accounts to record the increases and the decreases in this account when we look at transactions. So let's just put debit and credit on each of these. Let's look at a transaction for a second now. Well, you know what? Maybe I'll back up a second. I'll tell you that all assets have a balance side, whatever their asset, whatever their balance is. Let's say we had $2,000 in our cash account. If it's on the left-hand side of the balance sheet, the balance of the T account will be on the left side. So a balance of accounts receivable account, we'll say 500, it's going to be on the left-hand side. The equipment account, balance of 1,000, it's going to be on the left side. Liabilities appear on the right-hand side of the balance sheet. So what I'm going to do is I'm going to put the balance on the right-hand side. So accounts payable, we'll say, was 500. If total assets were 3,500, accounts payable was 500, owner's equity would have to be 3,000. Capital, the capital account appears on the right-hand side of the equation, so the balance will be here. So all we're going to use these T accounts for is recording the increases and the decreases in those accounts. Now here's the new stuff. When we increase an account, we increase it on the balance side. Increase on the balance side. Decrease on the other side. We call it the side opposite the balance side. Okay. So, if I bought equipment today worth $200, I would put it on the debit side of equipment and the credit side of cash. I put it on the increase side because I'm increasing what the equipment's worth. I'm decreasing cash, so I record it here. So you'll see that we're just going to record increases and decreases in each of these accounts. If I was to earn money today, let's say that I sold something for $400. I would earn $400 cash. I increase on the balance side. And owner's equity, our business would be worth more, so owner's equity would be $400. We'll talk about revenue and expenses here shortly. So in these T accounts, when we analyze it, we're going to have three parts. You'll have a cash, you'll have an account title, and a left side and a right hand side. Let's do one or two more transactions. Let's say that I bought a piece of equipment today and I owe somebody the money for that. I bought a piece of equipment for $300. So I have $300 more in the equipment account and I owe somebody that money. So I owe them, I increase it on the balance side. The balance side of accounts payable is over here. The generalization I want you to come to is that when we have a transaction, it's always going to affect at least two accounts. Maybe more, but at least two. And I'll also tell you that after every transaction, total debits must equal total credits. After every transaction. So let's do another one. I'd like to pay off some of this accounts payable today. I'd like to pay, let's say, $400 of my accounts payable. Any idea what happens to my cash account?
How much were you paying on?
400.
So would 400 go on the right side?
Yes. So we go 400 credit to cash, and accounts payable will be on the debit side, 400. So we call this, I debited accounts payable and I credited cash. If you can remember this, you always say the debit part of the entry first. Okay, so we always do things in the same order each time. Let's do one more transaction. Let's say that we sold something to somebody, again, for $600 this time, but they didn't pay us. They owe us the money. So we didn't get cash. It's going to be in accounts receivable. So we'll say we debit accounts receivable because somebody owes us more, and we're going to credit owner's equity, $700. Oh, $600. Because we want to make sure that debits equal credits. So again, all this is a method of showing increases and decreases in those accounts. At the end of my month, after I've recorded all of these transactions, I'd like to know what's in each account. So here's what I do. I draw a line. This is called balancing the account. I add up all the debits. I've got $2,400 here. I've got $600 here. These little things here, that's called a footing. I do these little footings. 2,400 minus 600 is 1,800. So then I go like this, and I circle it. This shows that the balance in the cash account at the end of the month is 1,800. Let's do the footings for the other accounts. The balance in the accounts receivable account would be 1,100. Now, if there's no credits, I can just simply circle my footing. I don't have to do anything else. Balance in the equipment account, 1,500. Now, I'm going to have to do some footings here because it was 800 and 400. So, liabilities have a credit balance of 400. And then in my owner's equity account, it was 4,000. I don't have to do anything there. Okay? So here's what we do. It's a little bit of a cycle. We start with an opening balance in those accounts. Those numbers will be the same numbers that are sitting in your balance sheet at the start of the month. Then stuff happens. Transactions happen, right? Those transactions happen and we record them. We record new numbers, okay, at the end of the month. So remember, I told you that accounting was like a cycle. So we went balance sheet, now we went into the accounts, into the accounts. Now we're going to calculate balances. Now here's a new one. After I've recorded the balances in the accounts, I'm going to create something called a trial balance. All this trial balance is I list all my accounts: cash, accounts receivable, equipment, accounts payable, and capital. I just list them vertically. And I record their balances in either a debit or a credit balance. So cash has a balance of $1,800. Accounts receivable has a balance of $1,100. Equipment had a balance of $1,500. Accounts payable $400. And capital $4,000. I add them up. So if my math is good here, it's $4,400 and $4,400. If I get this, if this actually balances, now I can do another balance sheet. Remember, accounting is a big cycle. So after I do this trial balance here, then I get to do another balance sheet so that I can see, did our company increase in value or decrease in value? As a business owner, I'm pretty interested in that, aren't I?
Yeah.
I want it to go up.